Another month has come and gone, and not that much has changed. For the most part, driver supply and demand are holding steady, and if the predictions are correct, we won't see any major changes in the market until we get to at least Q3 of this year, when it's believed that conditions will finally begin to change and take a favorable turn for trucking companies. The White House is making moves to try and establish a zero-emissions freight sector and has announced plans to spend at least $1.5 billion to help accomplish their goal. All that, plus we'll check in with Jason Miller to get his latest take on the economy and what we can expect moving forward. For Randall Reilly, I'm Joshua Miller, and this is the 30-Day Reset. Hey everybody, and welcome back to another edition of the 30-Day Reset. Each month we're back to take another look at driver recruiting, freight, and economic data. If you haven't already, don't forget to subscribe to our YouTube channel and click the bell for notifications. You can also get a copy of everything we go over today with our 30-Day Reset download. That's going to be available for you in the description if you're watching over on YouTube, but it can also be found below the video player if you're watching us over on our Randall Reilly site. Now, let's dive into the data. First up is Trucking by the Numbers, brought to you by Stratus Strategize. Not a whole lot has changed since our previous episode. Driver recruiting tallies are largely unchanged and relatively stable at the moment. It's believed we'll continue on like this with very little in the way of change until we get to that Q3 mark. It's at that time that the experts are now predicting that the market will finally shift and head into some more favorable territory for trucking companies. As it is right now, jobs posted and people seeking jobs are fairly consistent. Search activity is up, but just barely, and the click costs are flat in comparison to March. When it's all said and done, April's average CPL will more than likely be an exact match from what we saw in March. The one outlier is owner-operators. The average CPH has dropped by 25% on that segment, and the lead-to-hire ratio has dramatically improved. The improved LTH seems to indicate that some carriers are finding more freight, but they're still hesitant to add a driver to the payroll as the overall market remains uncertain, thus making them more likely to go for owner-operators. On the freight side of things, according to the latest FTR data, the overall broker posted rate fell by the most in 11 weeks. This comes as dry van spot rates dipped to their lowest level in almost a year, while at the same time, refrigerated rates increased sharply. Total load activity fell 9% year over year and ended up more than 32% below the 5-year average. Overall spot rates fell by 3 cents, hitting its lowest level in over a month. This total was about even compared to the same time last year and our 5-year average. By sector, we saw dry van loads and rates both down by 3% year over year. Refrigerated volume was down 8% year over year, but did see a 1% increase in rates. And flatbed came in with a 6% volume and spot rate decrease compared to the same week of last year. For a more detailed look at all the recruiting and freight data, check out this month's 30-Day Reset download, available down below. Now let's take a look at what's happening in the news. In an effort to combat pollution and improve overall air quality, the White House announced a new goal of creating a zero-emissions freight sector. As part of the plan, the administration calls for spending at least $1.5 billion to help reach this goal. Included in the spending is $1 billion from the EPA to provide to cities, states, and tribes to replace Class 6 and 7 heavy-duty vehicles, $400 million from the Department of Transportation to reduce air pollution from trucks at port cities, $72 million from the Department of Energy to create a program dedicated to showing how vehicle grid integration enables depots and truck stops to provide affordable and reliable charging while also increasing grid resiliency. The White House issued a statement saying, "The new commitment to zero-emissions freight aligns with and supports the President's existing goals for a carbon pollution-free energy sector by 2025 and for achieving net zero emissions from the transportation sector by 2050. That statement went on to say, "Freight movement continues to represent a significant share of local air pollution, increasing the risk of asthma, heart disease, hospitalization, and other adverse health outcomes for the millions of Americans, especially overburdened communities, who live and work near highways, ports, rail yards, warehouses, and other freight routes." Of the announced $1.5 billion, at least $400 million will go to serving communities dealing with significant air pollution. For more details on the funding and the White House's plans for this zero-emissions freight sector, you can find the full story as covered by Truckers News. A link to the story is included in the description on YouTube and below the player on our site. It's also linked in this month's 30-day reset download. Now, let's check in with Jason Miller for his latest economic update.
Not really much has changed from last month, though a lot of us were hoping that would be the case. If we sort of start off on the dry van spot market side, April has been another weak month. March was weak as well. And so dry van rates are essentially moving along the bottom of a trough right now, a little bit above $2 per mile, including fuel. Broker by contract rates that were hovering closer to $2.50 a mile in the high 240s. What that's doing is creating a huge premium for those broker buy contract rates relative to dry van spot rates. And when that huge premium exists, that suggests we're in sort of bear market pricing territory. Historically, a 10% threshold has been sort of the cutoff where the market flips over. Right now, we're at 20%. So as we're getting around to move into May, there just isn't much evidence yet that the dry van spot market is going to switch over, which is unfortunate for carriers. Now, if we take a look at the producer price indices from the BLS for the specific industry code that corresponds to what we think of as over-the-road dry van truckload operations, we can see that series on the left in blue. That's very contract rate heavy. That's been stalled out for the last couple of months. We've really basically been in a trough and sort of flat for roughly the last 7 to 8 months, kind of from, August or so of last year. That's very consistent with what the big truckload carriers are saying if they're not willing to take further rate decreases on some of that traditional truckload freight. So those contract rates seem to be essentially flatlined at the moment. No, the thing to keep in mind, though, is that over-the-road truckload piece is, for at least the big public carriers, a fairly small part of their portfolio. And what we're seeing is that the full producer price index that captures all services, so capturing those dedicated lanes as an example, that has fallen substantially less. And that's where you're hearing, so many of the big players are saying they are continually trying to shift more and more and more of their operations over to that dedicated space. And then just to put the current freight recession in perspective, if we look at the peak of the current cycle on a seasonally adjusted basis, that happened in March of 2022. That was peak demand, and that is actually the all-time record high freight demand. But from that point, we've seen trucking ton miles fall somewhere between 4 and 5% from that peak. So very likely January of 2024 with the polar vortex will be the low point, down 5% seasonally adjusted from that March peak. That is double the depth of the freight recession that occurred in 2019. The peak there was in August of 2018. It's triple the depth of what I call the fracking bust freight recession that occurred in 2015 and 2016. So this is the deepest freight recession we've ever had, that the whole economy has not fallen into a recession. It's comparative to what I always call the great offshoring freight recession that happened from about 2000, the latter part of 2000 until about 2003, as well as the 1990 trade normalization, Gulf War I, Cold War wind down freight recession that took place. But for perspective, the 1981 freight recession that was again interest rate induced, that was 3 times the magnitude of the current freight recession, actually displayed similar dynamics in that a trough wasn't reached till almost 2 years after the start. The 1973 oil shock recession, that resulted in a 4 times larger negative impact on trucking volumes. And then the worst in memory is the global financial crisis, where we saw a 20% decline in trucking activity from the peak in October of 2007 till the trough that was reached in 2009. So again, just to put things in perspective, this what we are currently going through now is 1/5 the size of what we experienced during 2008, 2009. So that helps explain where we're seeing very different employment dynamics. We'll be back again in May and hopefully starting to see some signs of improvement, given some of the manufacturing data is finally starting to look a little bit better. So until next time.
Thanks so much, Jason. Now, if you'd like to take a closer look at any of the charts featured that Jason was referring to, those are, of course, available in this month's 30-day reset download, along with all other kinds of information, such as recruiting search volumes, click costs and averages, and more. If you'd like to talk to someone on our team here at Randall Reilly to see how we can partner with you to help you reach your goals, let us know. There's a contact link in the description on YouTube, as well as a link for more information on Strategize. And all that can be found down below our player if you're watching us over on the Randall Reilly site. That'll do it for us here this time, but we will be back again next month with another edition of the 30-Day Reset. Until then, thanks for watching.